Okay, here's a system that I invented myself here, and what it is you want to make 10 times your money, and you want to make it without any risk. And what you can do is you can trade three mutual funds. You can trade during the second quarter. You can buy FSENX, a mutual fund on energy. And what happens is after Christmas, heating oil and natural gas tend to fall as the weather warms up, and then you just own FSENX in the second quarter. Then silver jewelry companies don't buy as much silver and gold, and they tend to cool off in the first half of the year. And during the third quarter, quarter of the year, you own FSAGX, a mutual fund on gold and silver mining companies. And then during the month of November, you own a mutual fund on the NASDAQ, on computer companies, or like HHH, like on internet companies. And they tend to do well in the month of November. And by doing this, you can have a target price of about 15% gain on each trade and make up to 45% a year. Now, the nuances behind this is that when you look at it, during the dot-com bubble, there were 1, 2, 3, 4 trades that didn't work out. So what you can do is during the market corrections, you can use a filter. Like what I like to do on the Dow is use the monthly MACD, and the monthly MACD gave a sell signal January 31st of 2000, and didn't give a buy signal till after more than 3 years had passed, back here in April, May of 2003. And if during that time you had been out of the market and you waited for a valid buy signal in the monthly MACD, you could have missed a lot of these false, where the market's pulling back and you get trapped in a down market. Also, during the subprime loan crisis, the monthly MACD gave a very timely sell signal in December of 2007, and didn't give a buy signal till after the second half of 2009, let's see here, like about July or August. And also, you would have then missed let's see, would you have missed this one? No, I guess you would have still been trapped in that one. But in 2008, it doesn't show on here, but if you look at the gold mining companies, they took a big hit in 2008 when we had the subprime loan crisis. They took actually a very big hit, and here's a graph of it. Here's a graph of FSAGX, the Fidelity gold mining mutual fund. They took a very big hit in 2008, and if you had been using you could either have waited it out and held it for like 6 months till it came back, or if you had been following the monthly MACD and the subprime loan crisis, you would be out of the market during that time. So we see by using the monthly MACD as a filter, it keeps you out of the market for sometimes up to half the time here. Over a 10-year period here, you're out a year and a half here and a little over, so you're out of the market almost 5 years here, or just about exactly 5 years. So you'd be out of the market. But it's usually not that bad. Usually the market collapses fast, like it did here at the subprime loan crisis, and then it recovers very slowly. And so you can see here the 3-year drop, and then you have this, like 5-year run up here after the dot-com bubble. So typically the market falls fast and then rises slowly. So you can use that as a filter. So the idea here is that when we look at this, that even if you didn't use the monthly MACD as a filter to stay out of the market, that that 3 out of 10 second quarters, FSENX, the Energy Mutual Fund, fell during the second quarter, and only 1 out of 10 years, the gold mining, only 1 out of 10 years, the gold mining mutual fund fell during the third quarter. But we know it took a big hit in 2008. But you would have had to have waited that out, or you could have just taken the loss and then you make it back up on the trades afterwards. And so those are the gotchas. And then here, if you had been out in the dot-com bubble, there was a big hit there in this year, and there was a slight drop here. But all these other Novembers, the Nasdaq closed up. So this is a method where you can trade big money safely because mutual funds don't go bankrupt, and you're getting in on the season where they typically are hot for seasonal reasons. The heating oil and the natural gas, they have a little rebound after the first quarter when they fall too much when weather heats up. Then you have jewelry companies buy silver and gold the third quarter. That pushes up silver and gold. Typically the dollar is weak during that time too because the last of the second quarter announcements comes out and they don't have any Christmas sales, so those tend to be weak, a weak point in the year. And also November tends to be very strong when transportation, utilities, distributors, hiring, manufacturing, all tends to do well prior to Christmas sales. That tends to be very strong in November. And so so this tends to be a safe method to use to trade. If you have your retirement fund and you want to trade it very safely, you can use a method like this because mutual funds don't go bankrupt. And another benefit of this is that because you don't stay mesmerized with just one sector, you can let like silver and gold cool off the first half of the year because you're trading, you're waiting for a good entry point to enter into the energy and then exit it, and you don't jump into the gold and silver, mutual funds too soon. Like 2013 is a very good example. 2013 and 2012 very good examples where the silver and the gold mutual funds and silver and gold themselves pulled back the first half of the year, and then they rallied in the third quarter. Well, since you weren't in the silver and the gold, you wouldn't be liable for that. Also, since you only own the Nasdaq in the month of November, you would have missed the Black October of 1987 because you weren't in October, and you would have missed the Black December of 1989 because you wouldn't be in December. And so this method works because the economic news looks very strong in November when transportation, manufacturing, hiring all looks very positive prior to Christmas because they're manufacturing more, transporting it, and hiring more people prior to stock shelves and to work cash registers for Christmas. So November, it tends to look very, very positive. That's why November tends to rally strong. And so you can use as a filter the monthly MACD, and you could have avoided this drop, but like most of us, you were probably in the market, and you'd probably have to figure out later how you can try and make up that kind of money. So I hope you liked the video. Have a nice day. Bye-bye.